Please, speak as you might to a young child or a golden retriever. It wasn't brains that got me here, I can assure you of that.
It's Saturday morning, it's the middle of July almost, and temperatures are skyrocketing higher. So I guess at the end of the day, Greta Thunberg was right. The climate, it's really warming up together with the planet, right? Jokes aside, welcome back for another weekly market recap at the end of a week, which again was a little bit boring, not huge swings in price action. But, you know, at the very least, the good news is that there wasn't a lot, even from the economic calendar standpoint. As you can see, we got ISM Services PMI, which came up in line with expectations, considering this is the fusion index. Hovering around 54, it's still good, still signaling expansion. And, you know, we see that even the employment sector of the index actually rebounded a little bit. Might be, you know, seasonality, people starting to travel, holidays. We had probably, you know, spring breaks and all the rest. So, you know, it's normal that people are hiring more in the servicing sector. Although, again, I remember last week we watched that leisure and hospitality component of NFP going down for the first time in months. So I don't know what is what in this case, but nonetheless, the data was good enough. And even from, you know, the survey, as for the inflation part of it, people responded that, yeah, I mean, although tensions in the Middle East, prices are not really running away for now, so we'll see in the future. After that, we got what? ADP employment changed, although this is the weekly release. I guess nothing to see here. It's decreasing a little bit, but you know, nothing too serious, I guess. Plus, you know, very volatile. It's a weekly data, so nothing to see here for me at the very least. So moving on, we got jobless claims, which yeah, they ticked up recently and they are staying a bit higher than, you know, the usual. I mean, they're actually staying in the middle. Again, it's nothing new. They just rebounded a little bit, both for the headline jobless claims and the continuing. And of course, the 4-week average. So again, can they pick up a little bit of, you know, weakness, or, you know, the labor market being a little bit more tepid than what it used to be considered? Maybe, but again, at the end of the day, I think this data, it's wildly corrupted by the gig economy and whatnot. So I'm taking it with a grain of salt, all right? What else? The usual 10 years or 5 years of break-evens, still signaling the same massive spike. And they came all the way back down when oil collapsed back to, you know, pre-war prices. And, you know, recently they are kind of going sideways, a little bit of a bounce, but they are mostly going sideways at the end of it, right? As for Fed Watch, we have seen another bounce. So we are back to 34% odds of a hike next meeting, which again, don't really believe there will be a hike, but yeah, that's what the Fed Fund future market, it's pricing in for now. Credit spreads on the floor, so nothing to see here. At least, you know, the market is not perceiving any type of risk in this sector, or, you know, in this segment of the bond market. So I guess at the end of the day, everything is kind of cool, at least on the surface, right? And, you know, that should be it for the economic calendar part. Let's jump into the chart straight away and let's see what we got. I mean, we got the DXY, which basically did nothing. I mean, yeah, it started the week up, as you can see. Then it came back down a bit, but then it bounced on a Friday and still kind of maintaining this old level, which was resistance first. And then it's now treated as support. So, you know, if you look at the entire area rather than a straight line as a level, but you may say, you know what, for now, this is confirmed as a legit break out of the range, and potentially we may see a higher DXY index. Although, again, I would wait to completely call it for, you know, a break, retest, success, and up we go for, you know, at least seeing the market going kind of like this, right? So starting to break short-term highs, so to speak, right? because up until the point it goes sideways like this, there is still the possibility that it makes another lower high, and the chance for failure and falling back into the range is still on the table. So so far so good, so to speak, but mostly sideways, so nothing really changed in here, right? Same as nothing changed in foreign currencies. It's basically the same, just in reverse. We could notice that the euro is a bit weaker than the pound. Look at the British pound and the bounce that we've seen in that. It's a much more relevant bounce compared to what the euro put together. Japanese yen went sideways. It was down initially and then it rebounded throughout the end of the week, but it's still on a downward trajectory and still, at this point maintaining below 160, which again should be above, but I inverted the chart just to have it, with the same orientation as for the rest, because in this one, the dollar, it's at the numerator, right? Instead, in these other ones, it's the denominator, which is kind of the same I did for the dollar Canadian and the Swiss franc. So you can see that all the foreign currencies have the inverse relationship with the DXY. I guess it's a little bit easier to comprehend if you look at them this way, but it is what it is at the end of the day, I guess. Speaking of dollar Canadian, nothing, a little bit of sideways action, slightly up maybe, but still in the context of a huge dump, and at the very best is maybe just a pullback. Swiss franc, same, nothing new in here. I guess everything is kind of drifting lower against the dollar for now. So, I guess not a lot of volatility as you would expect from currencies. So let's move on to the others, which basically the same, right? Chinese yuan, sideways, South African rand, sideways. The ruble put together this bounce, kind of like the Canadian dollar, grinding a little bit higher, maybe drawing back this down leg, but nothing really changed in this one as well. India rupee, same. It drew back and then collapsed back lower. I mean, relatively speaking, it was just, another dump, so to speak, and now we are seeing it going sideways and doing nothing. The Brazilian real, it's the one which is showing a little bit more positive signs at the end of the day, bounce off of this level, and at least, trying to extend the bounce for now. So among all of these, it's kind of the best one if you want to be bullish. And the Australian dollar, back to range low and then, bounce, but nothing substantial for now. And still, you may say, okay, we need to feel the inefficiency back, but we will have anticipated resistance in here at this point, right? So as you can see, currencies, they weren't particularly interesting this week. So let's move on to the next one on the list. Next one on the list, which should be Bitcoin, which again, kind of like, it dropped a little bit and then it bounced. So, I guess at the end of the day, expectations were met, so to speak, in the sense that we had a little bit of sideways action. Because, if you zoom in, right, let's say Monday started in here, right? So it went up and it came back down and it went up again. So just up and down, sideways. Trading in some sort of a range. It's not really a range in this case, but, going kind of sideways and slightly up maybe. So I guess not bad. I'm still thinking we should be able to reclaim this high before, calling it out of the woods. But, at least we didn't have another immediate, right, lower high and immediate continuation lower. So that would be already a good start if you want to start to be a bit more bullish. Although, I guess, I don't know, for next week, it depends a lot on what will come out. We're going to have inflation data next week with CPI, PPI, and then we're going to have retail sales, consumer confidence, the preliminary. So I guess all these markets will be a little bit headline driven because, from inflation, the market will start to try out to price in what the next Fed move will be, although Kevin Warsh actually signaled that they are not going to rely on forward guidance from now on. So I guess the market is a little bit more free in that process of autonomous price discovery rather than hanging on each and every word from that podium. But, the relevant factor for me for now is that at the very least, Bitcoin kind of halted or slowed down the downward trajectory. Again, if you look at it in the grand scheme of things, is it out of the woods? No, not really. But, usually bottoms, unless it's a V shape due to some exogenous event, and then, a massive intervention, which causes the V shape. Usually, if it is a natural bottom and it's following the natural course of the market, I think it would be more natural to have it a little bit sideways, building up a base, and then try to go higher. So if there is a little bit of accumulation before the next, leg up or a trend reversal, that would be even better for me. So for now, not a lot. Let's have a look instead at the other precious metals. All sideways across the board. If not, again, copper, which, the structure is much more positive than the others, but this week alone, I think you could say it went sideways as well, right? Down Monday, Tuesday, and then up for the rest of the week. So, everything kind of followed the same type of behavior this week. Gold, what about gold? Which basically, if you remember last week, I said expectations for gold are basically the same, copy-paste the ones for Bitcoin. I guess it delivered. It went sideways. Although, Bitcoin is near the recent highs, if I remember correctly. Yeah. While gold instead, it pulled back, but didn't really reach back up into the most recent high in here. So kind of the same behavior, maybe a little bit less relative strength in here, I guess. But, the pattern, at the end of the day, it's the same. We are seeing descending market, which is start to find its footing, I guess. So I would take it as a positive in the sense that at least we are not collapsing violently for now. And again, expecting this area to crack with just one test, it was a little bit of a long stretch. So I think even if you expect gold to be lower in the next weeks or maybe throughout the summer, I would say it may be a slow grind down. So it's natural that sometimes you're going to have these poses, right? Although again, at this point, both for gold and Bitcoin, I would say, look, you have a high in here, right? And then let's get rid of these for a moment. You have these lows in here. So just wait for it to break one way or the other. And for now, being a static chart for now, it's not moving, the market, it's closed. For now, I would favor a further retest of the highs. And then we'll see what's going to happen from there. All right, so that would be it for gold. Let's have a look instead at oil, which, we were looking for a bounce. We started to talk about it like 2 weeks ago, maybe. We had it in the sense that we filled the gap completely. And from there, if you remember, we were recording last week and the market was here. Monday was some sort of a doji, and then Tuesday, Wednesday, we bounced. Oh, kind of a good bounce. See how these candles are very, very thick with not a lot of shadows, if not at the highs. Now, if we zoom in, remembering what we were talking about last week. So we got this level, right, which was tagged and then exceeded. So I guess probably, my mistake or my overlooking. I was, I said, if it's not this one, it may be a test in this one, right? Old level, right? I kind of discarded this one because, didn't seem very relevant, all things considered. But if you just look at this segment right here, this is a fractal of the larger one. So you see the spike, and then price gets back in here and slowly bleeds out. But if you zoom in even further, what you see is kind of the same, right? Price spikes, gets back to the lows, and slowly bleeds out, and it collapses down. So again, if you think about these tiny little price segment, right? This behavior right here, and then you zoom out on a 4-hour chart, is that just, expanded on a much larger segment? That would be it. And again, that is the fractal nature of price action. It's not what you see people posting on the internet, like, a chart which behaved like this on this specific time frame 20 years ago, and now on the same time frame, it's moving in a way which is really, really similar, and people now expect the whole to play out exactly the same. That's not really fractal nature. That's just an analog, all right? Fractal nature, it's basically having different patterns of price movements, right, on different time frames, which are all, built up, between them and one inside of the other on different time scales, and they all behave similarly on different level of magnification. That's real fractal nature of price. It's not copy posting a chart and saying, I did this 20 years ago, so it's going to do exactly the same. No, right? So this is a good example of it, all right? As for the rest, what about now? I mean, throughout the week, the US kept on bombing Iran. The traffic in the Strait of Hormuz, of course, fell a little bit, obviously, okay? So I guess last week it was 30, 35 ships per day. I was reading a few data, although again, disclaimer, I don't know how much reliable they could be, but they were talking about now that number being down to 24, 23 ships per day. So it's decreased, right? But I mean, it's just 1 week, and who knows where we're going to go with this conflict, right? Every day is good for stating something and then immediately denying it. So, the Iranians saying that they have the plan to basically kill the president of the United States. I mean, he answered, yeah, I know, I'm the top of the list, right? But listen, I left instructions. If they kill me, they're going to be hit with something they never see coming. And who knows? You can think about everything at this point. Like, what do you think will happen? I mean, if some way Iranians manage to kill the president of the United States, I mean, I would expect Iran to, be wiped off the map with probably nuclear weapons. They would completely vaporize the entire region. If imagine that, even from a reputational standpoint, like if they kill your president, what you're gonna do? A few more missiles and JDAM bombs, bunker buster bombs? No, you're gonna vaporize the entire population. Just to give an example to the other nations, I guess. But regardless, that fantasy type of narrative, what matters for us in oil is that, all in all, right, if you zoom out on a daily time frame and you let alone all these fractal behaviors and whatnot, what you see is that at the end of the day, at least for now, this looks like another lower high. So we'll see next week if we keep on going down and, forming a lower low below this one, or, as I would expect, a little bit more, even this one, we keep on going kind of sideways like this and potentially slightly trying again higher, considering what's going on in the Middle East for now. I would wait to call a complete collapse. First of all, because we kind of got back to what the price would have been before the conflict. And secondly, because again, we still have an open conflict. So it just takes a headline, whatever. So, best way I can see it trading, it's sideways, because, if it spikes back higher again, it's going to trigger inflation expectations to run high again, and therefore potentially risk assets going down. So I wouldn't like to see that. But, if it goes sideways, it might be, the market is digesting the entire thing. Yeah, they are re-escalating again, but probably it's not going to be that type of escalation which bring the whole world onto the war path. So it's not going to be that disruptive, right? So I think sideways would be better, all things considered. And sideways, it's kind of what I expect. But again, very headline driven. You never know. So just be very careful and be very sharp in reassess your expectations very, very quickly in these type of markets with these type of geopolitical conditions and, situations, right? Now, after that, let's have a look instead at the treasuries, which were sold off this week once again. And so conversely, what you've seen is yields going up again. Now, I mean, we were talking, I guess, 2 weeks ago about these movements in the yield curve. So, you think about what a yield curve is. It's basically, you take the different maturities, you register the yield at that point in time, and you put all those numbers on a chart, and you kind of draw a line which links all of them together, and you guess what you got, a curve, basically, right? Now, we are now seeing a bear flattener. And should I really explain what it is? Oh, let's do it. I'm going to take the oil chart because we need a little bit of a screen real estate for it. So imagine that you have your usual two axes, right? One, the vertical one, right? In this case, in our case, would be for, let's call it R, right? I mean, I could call it Y as for yields, but let's just call it R as for rate, right? And then on here, you got T for time, right? So let's say you want to borrow money for, I don't know, let's say 2 years in here, right? And the lender will ask you maybe, I don't know, let's call it 3% just for the sake of the numbers. Another guy may want to borrow for 10 years, right? In here, let's say 10 years, right? And the lender will say, you know what? For 10 years, I can give you the money, but I'm going to need to have, I don't know, 5%. Jesus. 5% rate. That's what I will charge you. And then another guy may want to take out a mortgage for a house, right? And again, these are all random numbers, just for the sake of the example. And the bank will say, for 30 years, I can give you a loan on your house, but I'm going to charge you 7%, right? So obviously, if you draw the dots in here, what you see is that at the end of the day, when you link all them up, what you see is a curve, which is going up. It's steepened, right? Why it is so steep? Well, because it's natural that rates should go up the more time progresses. The longer you want to borrow money for, the more, the higher the yield that the lender needs to collect will be. Because of what? Well, mainly two things. It could be many other different things, but I guess the two main factors would be, one, duration. If I lend you money, right, if you look at it from the side of the lender, if I lend you money for more time, I'm taking on more risk because I don't know what may happen in 30 years. I can kind of know better, or I can have a little bit of a better assessment of expectations of what's going to happen in the next 2 years, but I don't know about the next 30 years. So I'm going to charge you a higher yield so that I'm compensated for that. It could be whatever. You could die, you could have an accident and you're not able to work anymore, so you're not generating enough income to guarantee that you are able to pay me the money back. So whatever, it could be whatever. And then you have opportunity cost. Because if I lend you money for 2 years, right? After 2 years, supposedly I'm going to have my money back and I could have the optionality to redeploy them in another form of investment, which maybe would yield me more, up 2%, 3% in this case, right? But if I lend you money for 30 years, that capital is locked in with you for 30 years. So I'm not going to be able to capture something which maybe would yield me more of 7, 6, 8%, whatever you. So I need to be compensated for the fact that I'm locking in that capital. And now I'm basically giving up on future potential better opportunities for the next 30 years, which is the duration of the loan. So these are more often than not the main two things which are factoring when you need to assess why a yield curve would be steep like this. And then, of course, you may have term premium, inflation risk. The calculations are kind of infinite if you want to try to factor in everything you can think of. But this is kind of basic explanation. So when you look at the yield curve now, and we say we have a flattener, which it's much better represented in here, if you want, which is basically the yield curve, right? You see it's steepening out and then it roll over, so it gets a little bit more flat, right? A flattener, it's basically this. When the short end, it's coming up, right? And the long end, it's coming down, obviously. So the result is that now you may have a line which is a little bit more like this, maybe. Still steepened out a bit, but a little bit more flat. And then, of course, if you want to go the complete other extreme, when you have an inversion, which on the chart would be these periods where it's below the zero line, well, on the chart, that would be obviously like this, where you have short-term rates way higher than long-term rates, which doesn't make sense. If you think about what we discussed in a few minutes ago, it wouldn't make sense for the lender. Or would it? It depends. I guess, when you look at an inversion, there are many different factors which could trigger an inversion. It could be the market kind of repricing expectations for the future path of interest rates. It could be the market assessing economic growth in the future and saying, you know what, I think economic growth will be lower in the future. So naturally, since yields are a reflection of economic growth and inflation expectations, I would expect yields to come back down. So it doesn't matter if in the short term, the Fed, right, thinks it needs to be particularly hawkish and they hike the rates. But in the future, I see those rates coming back down. So I'm going to make so that the long end will come down and the short end is coming up because of its, the interference of the Fed. But, if you look at how things played out in the past, every time we had an inversion, sooner or later, we uninverted and we came all the way back up to what the yield curve should look like. So steepen, all right? Now, we call it a bear flattener for now, right? If you look at these, right? It is a bear flattener because in this case, as you can see, yields are going up. And because of the invert relationship, treasuries are coming down. So the bear part of the definition, it's related to the treasury movement. So the curve, it's flattening out, right? It's going flat in here, right? While yields are going up and bonds are going down. So a bit more bearish for bonds, which is why it's a bear flattener, right? So little bit of a bond market jargon there, all right? So this is what we are looking at on the yield curve for now. And people say that the yield curve lost its relevancy because every time in the past it inverted and then it got back to steepen out. It basically called a recession. This time around in 2022, it didn't. So the signal failed, basically. I guess, the thing for me is that this is more, rather than being a real signal of an absolute reality into the future, that's more of the market pricing in expectations. And, coincidentally, in the past, which again, we're just looking at the 3-4 iterations, all of them getting back to the 80s actually anticipate a recession. So, if this time around it doesn't happen, would you say it completely lost its validity? Well, I don't know, 7 iterations, 6 out of 7, it preceded a recession. So overall, statistically speaking, it's a little bit weaker than before. It was always right before, right? And this time around, it didn't get the recession signal. So next time it happens, would you say, oh, I'm going to completely disregard that because it failed last time? Yeah, sure. Then what? It's like if you have a trading strategy which gives you a 90% win rate, that one time where you lose the trade, you're going to say, you know what, I'm going to ditch this strategy because, it doesn't matter if it won the last 900 times out of 1,000 that I tried, but this time around it failed, so it lost its validity as a strategy. Doesn't make sense, right? So again, just look at it in terms of market expectations rather than an actual timing mechanism. And I guess you would be much better off, right? So again, still talking about interest rates and, looking ahead to CPI next week. Let's have a look at what the interest rate swap market is doing, actually. So if you don't know what a swap contract is, especially when it comes down to interest rate swap, I made a video, I think, but at this point it's particularly old, maybe months, so I'm not blaming you if you don't remember. A swap it's just, in the case of interest rates, it's just an exchange of cash flows, of yields. And usually in these transactions, there can be many of them. The most common one, which is used for example's sake, it's the vanilla spread, where, basically you have one side paying a fixed type of a yield and the other one paying a floating. The rate which is used to determine the value of the swap, it's usually the fixed. And what you see is that when the fixed come down, it kind of works like, every other yield on normal treasuries. If the yield is coming down, the flat is coming down, it means that there is more demand for people to buy the spread where they pay the fixed, right? And they receive the floating. It could be the other way around, to be fair. I inverted that. There's more demand to receive the fixed, right? That makes sense a bit more. It's kind of like buying a treasury, right? And you may say, it doesn't make sense. You are paying more. I mean, you are bidding up a contract which pays you a fixed, let's say, 3%, but the yield on an actual treasury, it's now, 3.5, right? And you may say, yeah, I know, but I think rates will be lower, so I'm willing to bid this instrument now, which grant me a 2.5% yield, and I'm willing to pay for now a 3.5% yield on the floating side, right? I'm losing on the transaction for now, but this spread, this swap is set up to last 10 years. So I'm thinking I'm going to lose on the transaction for maybe 1 year or something like that. But then when rates collapses and, I'm still receiving the 2% fixed, but now I'm paying the 1.5% floating, I'm going to make money on this. So if you see the fixed going down, that's the market telling you they expect lower rates into the future. I hope it makes sense, but, in any case, you still have Gemini or ChatGPT for that. If you really want to know everything about interest rate swaps, everything in the bond market, it works kind of counterintuitively. For me, it's not like the stock market where everything, the way you see the chart moving, it's usually the way the market is pricing in stuff. With bonds, with treasuries, with swaps, it's a little bit different. You need to factor in different things, and you need to know the dynamics and the underpinnings and the mechanics of those markets, all right? But, again, for now, I would say this is enough for the first part of the charts. Very briefly over the first part, because, currencies, Bitcoin, gold, not a lot. A little bit more on oil and treasuries, because, remember, oil and treasuries, aka yields, are particularly linked in this period, just because, oil plays a good role in setting up inflation expectations. So it's natural that you see oil going up, yields spiking right behind it. Oil coming back down, yields being a little bit more tame overall. Then again, yields are moved by many other different facts, right? A little bit of a glitch there, but we should be good to go, I think. It glitched out, but yeah, I think we're back now. So I was saying, yeah, a little bit of a good correlation in between the two, oil and yields, especially over the past months. But remember the yields could be moved by many other different factors. Dollar shortages, people selling treasuries, so just take it with a little bit of a caveat, all right? And with that, let's have a little bit of a pause and then coming back with the stock market for the weekend, wrap up the video. Looking at equities now, I think it's kind of the same story of last week. You see that ES mini futures, they were a bit stronger than NQ futures. Just look, for instance, at the previous weekly low, right? It was back in here for ES, and you see this week, we took out Friday's low, and then we immediately go back higher, and we basically closed the week higher compared to the Monday's high. And we never came back near the previous weekly low, as you can see in here, right? Instead, NASDAQ, we took out the previous weekly low, obviously, previous Friday's low, right? And then it's not Friday, previous Friday's low would be here, but, that was by definition the previous weekly low here, and we took it out. And we didn't come anywhere near the previous weekly high, right? So still, NASDAQ, it's lagging a little bit, right? As we can see from here. On a daily time frame is much more evident, right? They both took out a low recently, all right? But, after that, you see the S&P actually coming back up and trading above this short-term high, while instead NASDAQ is still there in here. Not only that, but, we are lagging a little bit, but I guess at the end of the day, sideways is good, right? The Dow is still relatively stronger compared to everything, and even the Russell, it's at least it's maintaining the gains. Now, overall, if you think about what we've seen, right, after the the April lows, and then the huge run up. Look, consolidating and going sideways for a little while it is a positive sign, right? It's just the market going up and up and up, and then taking a breather, taking a pause, digesting the gains, and building up acceptance and new volume structures at a higher level. So you should keep on taking it as a positive. Don't discard the risks, of course. I'm not saying you should completely abandon the risk assessment tools that you have, and saying, you know what, I'm just going to buy and forget about it. But from that, between that and saying, this is the end, we're doomed, the A bubble burst, there must be something in between, right? So don't let your mental pendulum swinging from one side to the next without transitioning from from the middle, right? So look, these are the layout right here. What you see is that moving averages are not really helping you out a lot recently, especially the short-term moving averages, like the relationship in between the blue, which should be a 9 or an 8 exponential, and the yellow, which should be a 21 exponential. They are particularly close together for now, which is just testimony that the market is going sideways, right? But if you look at the long-term averages, you see that for now, we are still maintaining price levels above the 55 exponential in this case. You could throw at it a 50 simple moving average. I think it could be kind of the same. I just like exponentials because they are a little bit more reactive, but you pick your poison there. RSI for now, it's basically neutral on the Qs and kind of neutral on SPY. So, we kind of digested that bearish divergence we got in here, right? High highs in price, lower highs on the indicator. And for now, the indicator is neutral, price goes sideways. The stochastic, it's maintaining above the bearish area on the Qs. So again, it's not a super good signal, but at least it tells you that we are not going in a bearish territory, right? And as for the SPY, it's actually pointing up, so not bad. MACD actually triggered a momentum buy signal in here. So, could this is where we start to see July seasonality playing out? Who knows? We'll see. Because, on the cues, we didn't trigger that same signal. Now, I guess for now it's kind of in limbo yet, but I guess, it's still a positive all in all if you zoom out enough, right? Now, one thing I would say, last week we were looking at different stocks and potentially different sectors, and let's review what's going on this week. So Apple again was up last week, up this week. Amazon slightly up. At least it didn't give back the gains of this bounce, right? Google down, but kind of closed near previous weekly close, so kind of like a nothing burger for this week. Meta massively up this week. Microsoft kind of like Google. Nvidia up, so good for Nvidia. Tesla trying to consolidate the gains, but more of the gains, I would say, bounce, huge rejection, trying again, I guess, if you just look at the weekly chart. So again, I think overall, this rotation back into growth, at a point, it will manifest itself. I'm still thinking that. And, we will see how it plays out. But if you think about earnings growth and all the rest, I think there is no reason to not bet on the Max 7 for the rest of the year, right? And for instance, if you want to have a look at these, right? There are different ETFs, right? There is an ETF which is just tracking momentum, okay? So momentum, it's basically trading and trying to keep the pace and keep on piling in those stocks which are performing particularly well. It's called momentum. It's not a case, right? But do you remember that narrative, which is kind of the same we got at the beginning of last year, right? Nobody wanted the Max 7. Nobody wanted tech. Nobody wanted the hyperscaler. AI was the bubble was already popped, even at the end of 2025, getting into 2026, and then what, right? So if you look at these, and then you look at three different charts, as you can see. Now, in the top panel, you have Max, which is the ETF on the Max 7, and the ratio in between Max, the ETF, and the Momentum ETF, right? In the middle quadrant, panel, whatever, you have the two different ETFs, each one on a different chart, right? And I think the Max 7 should be the blue, and Momentum should be the green. And, in here you have the index. So with the ratio, you can have a graphical depiction of what the relationship in between the Max 7 and the Momentum ETF is. Recently what we've seen is that obviously Momentum was overperforming the Max 7. But, if you look at it, is it really because the Momentum is performing so well, or it's just because the Max 7 are pulling back? You throw a 50-day simple moving average in it, and you see that we are still in that context, right? The ratio just pulled back in that 50-day moving average, which so far provided resistance on the way down. But if you look at these, right, could this be the start of another rotation? Because, initially what you see is that, in here, it's right when the Max 7 are starting to collapse, and instead the Momentum ETF, it's holding up relatively better, so it's overperforming. Can we see a flip once again in here? Whereas you will see the Max 7 gaining bad joke. How could you call it? Gaining traction, right? Can't say momentum once again, otherwise nobody will be able to understand. But let's say the Max 7 actually gets traction and momentum fades out a bit, or it starts to overperform the Max 7. You would see the ratio being flipped, the blue line trading well above the green line. And if you look at the relationship in between all these things and the stock market, what you see is that usually you see the stock market is really going up when the Mag 7, it's actually doing the heavy lifting. For instance, look at that, all right? When you see the momentum going down, I mean the momentum, the ratio, right? The ratio in between the mags and momentum going down, you see both ETFs are going down. It's just that the Mag 7 is going down faster than the other, right? And you see what? You see the index going down. Why is that you see the index going up? Well, when the momentum starts to overperform the Mag 7, right? The Mag 7 climbs back higher and it starts to gain traction more than the momentum ETF. Because what? Because of market capitalization at the end of the day, all right? The majority of the index is represented by the Mag 7 at the end of the day. So you need them to do the heavy lifting to bring up the index, right? So as you can see, up until the point the ratio is positive in favor of mags, the index is going up. Then what you have at the beginning, end of 2025, beginning of 2026, you have a shift in the ratio in between mags and momentum ETFs. And what you see after that, you see the index coming back down. And then what you see in here is that you have the bottom in here in April, and the heavy lifting, it's made not because, or not necessarily just because the momentum ETF is going up, but because mags, it's gaining traction once again. And you see the ratio going flat for a little while we have these huge bounds. It's basically this segment right here, right? So see, the ratio is going down. The Mag 7 are putting in the low and going up. Sure, even momentum is going up, but mags are just going up even faster. And they are collectively picking up the entire index and bringing it up together with them. Because of what? Market capitalization, once again. So if we see the index going sideways like this, in a period where mags is underperforming and momentum is overperforming, if you can flip this dynamic in between mags and momentum, and you can get a little bit more of appreciation in mags, I would say that's a good reason to see overall the index being brought up, being lifted. So again, take a little bit of a, take it into consideration, especially when you hear all this narrative about, Mag 7, now they call it the lag 7 because they are lagging the market. Rotations are normal, right? The market could be one way or the other, and one sector could overperform, underperform. Sure, that's fine. Money will try to rotate, okay, but if you're thinking about the index as a whole, just remember who is doing the heavy lifting, right? So that would be it for this tiny little curiosity, if you wish. As for the rest, what we have when we go down the path of risk assessment, volatility. So it could be, I'm not saying it is, but it could be a warning sign in the sense that we have seen for now a period where realized volatility was lower, so it was trading below the VIX, so the implied volatility. Now, in these conditions, since, realized volatility is lower than what implied, aka expected volatility would be, it's easy, it's a good condition to do what? To short volatility and buy risk on assets, right? What you do when these things starts to, don't want to say unwind, but reverse, or these two things, these two value, realized and expected or implied, are kind of converging on each other. Well, you have a situation where all those funds, all those strategies which are short vol, they're basically taking a huge risk now and they are collecting pennies, right? So it just takes a little bit to completely flip that risk-reward metric, forcing them to unwind those volatility shorts. And since on the other leg on that transaction, what they have risk on asset, if they need to unwind one leg of the transaction, most likely even the other will be unwound. And the other is basically holding, being long, risk on assets. So that could be, a little bit of a tail risk for the market, although it would need a trigger, it would need a catalyst, but nonetheless, it's something that you need to pay attention to. Also because when you think about this, which is implied correlation, what is implied correlation? So if you think about the stock market, there are 500 stocks in the index, right? When implied correlation, it's particularly low, it means that, as we've seen in the recent past, you have a lot of rotations. So money are moving from one sector to the other in the same index, in the same asset class, in this case, equities, right? And, you know, although a few sectors may go down, others will be up compensating and the index will be flat. If you have the correlation spiking to the upside, it means that all at once, the majority, let's say the vast majority of stocks will start to trade in the same direction, right? And if you pair it up with the fact that you may see a spike in realized volatility, when you have volatility going up and a correlation of stocks spiking to the upside from very low levels, what you should expect, it's a risk for a downturn. I mean, I'm not saying downturn in the sense 20 or 50 or 40% down, but maybe another tiny little pullback, who knows, or at least, volatility risk. Volatility risk paired up with correlation risk, because we are moving again from a very low rate, and there is only one way to go if you are low enough, which would be higher, right? And then what? Then you have positioning risk in a sense, because, this is the NAIM exposure index, right? And looks like a lot of people, in this case managers, not necessarily all the market participants, but managers, but could be money managers, fund managers, whatever you, they are already long. They are already allocated, exposed, right? So if you put all the things together, you have the VIX, which is still low, but it's kind of ticking up. You have the realized vol, which nearly doubled since early July, so over the last month. And you have no volatility premium to short anymore. There is no opportunity there, which again, because of the unwind in that segment, leg of the transaction, you could see the unwind in the other. And then you have people being already committed. So therefore, an eventual dip, the odds of that dip, seeing people ready to step in with fresh money to deploy, it would be a bit lower, right? Which is why, all things considered, the risk should be a little bit higher. Now, again, we are talking about risks. We are not talking about forecasts, right? So just because there is the risk, it doesn't mean that the market could go higher. It just means, in a way, that the market is a little bit more prone, a little bit more fragile, if you see a violent spike in the VIX, aka in volatility, while people are all on the same side of the boat, right? And stocks have been particularly decorrelating one to each other. So if that correlation gets back in line and all of them at the same time starts to trade the same direction, it could spark a little bit of a pain, hopefully short-term pain, but nonetheless, it's something that you should consider. And then if you think, again, we were talking about the managers, which they are fully allocated. So who would buy the dip eventually? Retail traders, they're still buying, right? Record activity in May, all right. And then what you have, the usual ETF flows, the passive bid, the giant mindless robot, already bought 1 trillion this year, 45% ahead of the previous records, right? Then you have CTAs, with computers trading algorithms, so the systematic strategy. They are max long, so it's unlikely to expect that in a down tape they would keep on buying. Actually, they could start to be sellers if momentum actually shifts, right? And corporate buybacks are now in blackout because we are basically in earnings season at this point. The pensions funds, they rebalanced at the end of Q2. They could be bidders, I guess, because I guess they already rebalanced their portfolio at the end of the quarter, so maybe they could, but I don't see them as huge risk takers. They are not chasing absolute and huge returns. They're just trying to manage the fund in the sense that they are trying to have more cash flow in than what they need to pay out. So probably they wouldn't step in, right? At least massively, to provide support for the market. And then you have margin, so leverage, which is already stretched for this week. You remember we always talk about the margin debt being at record highs, right? So, just a little bit of a setup for potential weakness in case the market actually pulls back, which for now it's not. So don't run for the hill yet. This is just a potential risk that you need to put on your bingo card so that if you wake up 1-2 weeks from now and you see, I don't know, the S&P down 3-4%, you're not panicking out and selling all you have because you think this is the top. But you know that something is going on. You know why, you know the dynamics, you know the risks. And potentially you already took actions, right? Maybe trimming your huge winners, whatever we always discuss, right? So that would be one thing, right? I mean, after that, overall things for Q2 are particularly good in the sense that Q2 was good. And therefore, if you look at historical precedents, the rest of the year should be good too. There is just one precedent, right, in here in 1975, where the market, returned more than 10% in Q2, and at the end of the year we were down. So, overall mid to long term horizons should be good yet. Throughout this period where the market it's going kind of sideways, and the Nasdaq it's underperforming the rest. What we've seen, of course, is a little bit of an improvement in what? In breadth. So the participation in the gains actually widened, and a lot of stocks which were struggling before are now participating in the uptrend, which again makes the market a little bit more genuine, a little bit more bullish overall, rather than, increasing that concentration risk that you usually see when it's just the Max 7 lifting the index. Although, again, it's a little bit of a conundrum because let's put it this way, if 493 stocks are performing well, but those seven are not, the market goes sideways. If those 7s are performing exceptionally, but the rest of the market is in the slump, the index is still going up. So again, it's another situation where you need to pick your poison very, very carefully, right? And at the end of the day, it's another reason why I keep on saying you need those Mark 7, and you need, at one point, you need to bet on them if you want to get market returns, right? So I will see how this earnings season will play out. A lot of tech sector companies will report, I think, in the 3rd or 4th week of the month. So, initially you always have the financials, then retailers, and, these guys, the big guys, are usually at the end of the line when it comes down to earnings. I think NVIDIA will probably report in August. It's always the last to report. So we'll see about that. Now, do you remember before we were talking about, I guess it was when we were discussing oil, analogs and fractals. Now, this is not a fractal, but this is an analog. All right. So here they are basically looking at the semiconductor ETF, so the SOX, and they are, quote unquote, forecasting or at least highlighting the risk of what you may or may not, but you may get in an asset which is going parabolic. And they're taking this recent run and comparing it with what we've seen in silver. So again, does it mean that semiconductors will keep on plunging from here on out? Not necessarily. It just says that at the end of the day, markets which go parabolic, they usually don't end up that run with a very gentle and soft consolidation and redistribution and ordered redistribution to the downside. They usually end up with a huge blow off top, and then, you could be, quote unquote, financially killed if you live through that, especially if you are particularly leveled up. So, just pay attention to it. Again, not saying it's going to happen here and now, but, leverage and parabolic runs are not something which ends up gently, right? And speaking of margin debt, again, another record high, 1.42 trillions in May. So I guess risk appetite is wild in market for now. Now, look, there is, I don't know, do we have time? I mean, the video is not that long, so I could actually go there just to kind of try to debunk another narrative maybe. But you know what, let's do it. Now, sure, margin debt, what we've said so far, it's good until it lasts. Obviously, it's fuel for the market to keep on going up. It's bad when it's acting in reverse because you have a lot of margin calls and all the rest. Sure. But although we keep on seeing red alerts about margin debt bid at nose bleeding levels, what type of metrics are we looking at, especially when you scroll down your FinTwit pages and whatnot? Because there are a lot of different metrics to measure margin debt, but not all the metrics are created equal. And here I'm going to show you what I mean by that. So, for instance, let's have a look at these first. Margin debt, right, as a share of market cap, right? Now, I think this one, it's not really a reliable source of information because of what? Well, I mean, there is a logical error in this one for me. Margin debt, it's, at the numerator, right? And total market capitalization, it sits at the denominator. But those two numbers are basically moving hand in hand in the sense that if price goes up, obviously market cap is going up. And therefore, if you use your portfolio, your assets, the assets that you hold as collateral to take out a loan and then reinvest the loan in the same assets, it's obviously that your ability to take on that loan will increase if the market cap of the assets that you're holding, which are going to be used as collateral, is increased. So I think both sides of the ratio are moving together. So the ratio at the end of the day is washing out the very signal you are trying to find. And again, if you look at it, since the 70s, these metric just hovers around the 1% and 3% level. So, I mean, again, look, in 2007, it was around 3%. And then in 2021, it was 2.6. And recently, it's 2.20. So again, record margin debt, right? 1.2 trillions. And yet, this rate, it's lower compared to 2007. But do you think, market participants are bearing less risk now compared to 2007? I mean, I don't know. But I don't think it's really a good measurement to look at, right? Then you have, of course, margin debt as a share of GDP. And you may say, okay, that makes sense. It makes sense. I mean, to me, not really and not completely, in the sense that GDP, what it is, it's what? It's just a number which expresses a real economic output. But as it, any type of transmission line on equity leverage? I think it doesn't. You could argue that maybe, I mean, if nominal margin debt is growing, so everything is growing over time. I mean, GDP is growing, obviously, because, if the monetary base is expanding, prices are going up, aka GDP should be nominally higher. So if both things are going up together, both, a GDP nominally and margin debt nominally, at least you could say that this is a good representation which can help you to compare the ratio of now with the ratio of yesterday, taking GDP into consideration and saying, well, I mean, they're both growing up, but at least we can look at the relationship in between two things which are going up at the same time, sure, but what the ratio in between them? I guess, I mean, let's say, for instance, now GDP it's 10, margin debt it's 3. fast forward 20 years, now GDP it's 20, margin debt it's maybe 7. So if GDP actually doubled, if margin debt more than doubled because you went from 3 to 7, not 6 but 7, yeah, okay, you may say, okay, we have more margin debt now relative to GDP compared to 20 years ago. Sure, but over time they will both move up together. That's what I'm saying. It's always going to go up. So this is another reason why I wouldn't put a lot of emphasis on it. I mean, it's the less faulty, I guess, in between the two. But again, for me, it's not good enough. And then you have, of course, margin debt as a percentage or a share of M2 money supply. But again, these charts can be vastly influenced by what the Fed is doing as for monetary policy. All right. So, M2, it's a monetary aggregate. So you're really comparing two things which doesn't have any link in between each other, in my view. All right. So, even in this one, is it normal that in 2020, at the peak of the market, before the 2022 mini bear market, were investors bearing more risk or less risk compared, to the 2000 or 2008? I mean, margin debt was higher, right? Nominally. So how can you say that they were bearing less risk? Again, so this is just a representation of what the Fed is doing rather than margin debt risk or how much stretched out people are when they actually pile money in the stock market. All right. Now, if you want to look at something which could help way better than the three things we have looked at so far, you may want to look at these. So this is basically the year-over-year rate of change. So to speak, you could look at it and say this is the momentum that margin debt is actually getting or losing. So obviously, if you see it skyrocketing, it gives you some sort of a metric about the risk appetite or the irrationality or the lack of risk acknowledgement or the complacency of the market. All right. So, I mean, this one, it could be a better one. And of course, when you see it going parabolic, soon after, it immediately collapses back down. So I guess that this one starts to be a good one at the very end of the day. But in my view, the best one would be this. So net credit balance. So that would be the cash that people have minus margin debt. So what does it tell you? But basically it tells you how much debt or margin debt you have compared to the amount of money, cash you have in your banking account. So for instance, if you have, let's say, $100 in margin debt, but you have $120 in your banking account, I mean, it's kind of good in the sense that you still have more money than the amount of debt that you have. So in case of a downturn, you would be able to pay down, to unwind that margin debt and still be good at the end of the day. But if now you have way less money, right? And you have an obscene amount of margin debt on top of them, in case of a downturn, what you're going to put up in order to meet this margin debt, aka margin call demands? You're going to need to sell assets. That's the only way you can get back the money to pay down the margin, right? To cover the margin. So, this is one thing that makes the market even more fragile, in my view. So if you want to look at the entire thing about margin debt as an indicator of potential risk for the market, this one is a good one. Probably the best one among all the ones we have seen so far. And of course, you could just look at margin debt relative to itself. So deviation from its own long-term trend. It's kind of like when you look at a stock, you come up with Bollinger Bands or you come up with long-term VWAP and you look at the first, second, and third standard deviation. So deviation away from the mean. Because what we know for sure is that deviations are always followed by mean reversion. All right. So if you look at it in this context, so far, for now, margin debt compared to its own long-term trend, it's not that high. You think at 2021, before the GFC, and in the midst of the dot-com bubble. So again, take it for what it's worth. The thing is that you don't have to take every single read or every single metric at face value without digging in what's really brewing behind it and how they are collecting the data, what they are comparing, and how they are building the chart. All right, there are a lot of charts crimes out there on the internet. All right, at the very end of the day, the logic here, the message is: look, margin debt, is it a problem? Absolutely. I mean, it's a problem when it gets unwound, but does it have any bearing on, the aim of trying to time market reversals? No. Actually, no, it doesn't. It just tells you that when that reversal comes, the magnitude of it may be a hell of a lot more severe if margin debt is way higher than normal or historical averages. Or, again, as we've seen, if people don't have enough money behind it to face those margin calls and therefore cover their margins without actually have to sell assets. So basically don't get margin called, right? So that would be for me one of the ways by which you should look at margin debt. And it's another way, it's another one of those things where you say, yeah, sure, it's incredibly high. Does it mean the market is going to crash tomorrow? No. It just means that the market may be more fragile and the eventual downturn would be much more severe. It's like stocks evaluation, like the PE ratios. Just because they're high now, doesn't mean the market is going to crash tomorrow? No. It just means that when you're going to have that compression in those PE ratios, if they are starting from a very high level, that compression is going to be even bigger, right? So again, it's kind of the same thing. Just wanted to put it out there, all right? So with that, I think there's really nothing else I want to discuss. Next week, we are going to have what? Again, as I said, CPI and PPI, I guess. Yeah, CPI on Tuesday, not on Wednesday. Okay. And then PPI, as you can see. And then what? Yeah, I mean, retail sales and the preliminary survey for the Michigan consumer sentiment. Although, remember, I guess it was not too late of 2 weeks ago where we went around the discrepancies and the flaws in the Michigan consumer sentiment reads. So, the political affiliation thing and whatnot. So maybe look at that and then try to look for the household survey and try to average the two to have a much better read, right? Nothing else for real. So with that, I'm going to leave you off, wishing you a very good weekend and a very good start of your next week. And hopefully, as usual, hoping and wishing you to be nice and to be cool, right? Niels out.
So, what you're telling me is that the music is about to stop, and we're going to be left holding the biggest bag of odorous excrement ever assembled in the history of capitalism.